The US recently saw a particularly unusual phenomenon. The stock market rose despite disappointing jobs data. This reflects a logic worth pondering. The market does not appear to be cheering for an improving economy but is rallying in anticipation of a weakening economy, expecting that it will force the Federal Reserve to cut interest rates. This creates a seemingly contradictory situation where bad news becomes good news. Today, we'll dive deep into the mechanisms behind this phenomenon, its underlying risks, and the signals worth watching in such a unique environment. The core of this anomaly lies in the market's high dependence and strong expectations for policy. When economic data softens, such as a decline in employment, investors widely expect that the central bank will be compelled to cut rates to stimulate the economy. Rate cuts mean lower borrowing costs and potentially increased liquidity, which typically boosts asset prices sensitive to financing costs. This expectation alone attracts capital to position ahead of time, leading to counterintuitive market gains after weak data releases. At its heart, this mechanism reflects market participants' strong belief in policy intervention and their strategic moves based on these expectations. However, this rally driven by rate cut expectations rests on fragile ground. The biggest risk is that the market rise is not supported by fundamentals such as improved corporate earnings or stronger economic growth but relies entirely on betting on future policy. If the timing or magnitude of policy action deviates from market expectations, disappointment could trigger sharp volatility. For example, if economic data remains weak but the central bank delays cutting rates due to concerns like inflation, assets that rose on strong rate cut expectations could face significant downward pressure. One complication in the current environment is incomplete information. Delays or gaps in the release of key official economic data mean both markets and policymakers are making judgments with incomplete information. This data vacuum amplifies the risk of misjudgment, whether in the central bank's assessment of economic conditions or the market's expectations for policy. As a result, the current market game has become more complex and uncertain. Any new information could trigger rapid adjustments in expectations and repricing of assets. Traces of this game can also be seen in market structure. Recently, sectors highly sensitive to interest rate policy, such as certain financial institutions and small to mid-sized companies, have shown relatively active performance. This shift in capital flows precisely reflects how participants are adjusting their positions based on changing policy expectations. Yet a structural contradiction exists. While the market hopes for rate cuts to lift overall valuations and risk appetite, if the economic outlook truly darkens, the fundamentals of these same economically sensitive sectors will eventually be tested. This creates a delicate balance whose stability will require validation from subsequent fundamental improvements. For market observers, understanding this internal logic is crucial. It reminds us not to simply focus on price increases but to ask what is driving them. When market momentum comes mainly from policy expectations rather than fundamentals, we must be more vigilant about potential expectation gaps. Closely tracking key economic data releases and signals from policymakers becomes especially important. These factors could become critical variables that reshape the current game. Moreover, maintaining rationality and calm is particularly valuable in such a highly uncertain environment. While emotional market swings may amplify short-term moves, over the long run asset prices will ultimately reflect their intrinsic value. Avoiding being swept up by short-term sentiment and sticking to analysis based on facts and logic is key to navigating complex situations. We must watch whether this expectation-driven rally can eventually gain support from real economic improvement that will be crucial in judging the market's future direction. In summary, the current bad news is good news market phenomenon results from the interplay of policy expectations and market sentiment in a unique macro environment. It reflects both the